So what is the current trend with new age stocks? Let's discuss this. And for that, Karan Taurani is joining us. He's, of course, Senior Vice President for Research at Elara Securities. Great to have you with us, Karan. Karan, tell us, if you're looking at this performance of these new age counters like Zomato and Paytm, a car trade, even a delivery, Nykaa, like my colleague was pointing out, and pbfintech, their numbers are out. They all seem to have rallied, these counters. Zomato, for one, has reported this rather good set of numbers. They've turned themselves into black, becoming PAT positive. Do you believe that the entire pack of these new age companies are turning a corner? And if so, what do you think are the reasons for this?
Hi, Vikram. Pleasure to be here. If you look at the reasons broadly, there is a convergence in growth for many of these companies. So I think, erstwhile, about 3 to 4 years back when the pandemic hit and we're just coming out of COVID, most of these companies were growing at, 30%, 40% kind of growth rates. And they actually didn't have a focus on profitability because they wanted to make deeper inroads in the markets. As compared to where they are today, as compared to 2.5 years back, it's a very different situation right now. Some of these businesses have a very sticky customer base. The frequency is like a very big driver now, as compared to new customer acquisition, which was a very big driver earlier. And now there's a clear intent in terms of focusing on unit economics, focusing on profitability. If you look at something like a Zomato, they've exited non-focus markets where the profitability is lower as such. If you look at other players as well, they are playing with multiple levers around profitability. I think some of the fashion-based e-commerce players are also charging a higher delivery fee. They're also charging a fulfillment fee. For example, if you look at Myntra, what they are doing clearly is that if the customer is kind of having higher returns, there's a higher delivery penalty or a fee which is charged to the customer. So I think they've kind of realized now that you need to focus more in terms of your regular customers or loyal customers rather to make this business profitable. And there are multiple levers to play with, right from charging delivery fee to advertising revenue to kind of lowering your marketing costs, everything put together.
But Karan, they all listed at these big, some would even say unbelievable valuations. Then they face these big corrections in the markets after they listed. Do you think the managements now stand a bit vindicated about the course of growth that they've followed? Because we are talking about different industries in which these new age stocks are present in. Or do you think it's too early to tell about this kind of performance, whether they're going to be able to sustain it or not? Even like a delivery, which seems to be cutting its losses right now, or a pbfintech, we're talking about good positive moves, but will it be sustained or not? And as far as valuations go, how do you think it's going to pan out?
I think definitely as far as companies like, Zomato and Nykaa are concerned, I think it is quite sustainable, as I told you, because there are multiple levers to play with. I think most of these companies are now getting this blend correctly in terms of revenue growth and profitability, whereas the earlier focus was just on growth, which obviously was not sustainable. So unless they don't start to chase growth of 30-40%, I think these kind of profitability measures that they're doing right now are kind of sustainable, right? Another big potential that you have to see, for commerce firms or firms like Zomato or for firms like Nykaa is also the competitive intensity in that particular space, right? So if you look at fashion, for example, or if you look at any other space for that matter, like food tech, discounts have come down very sharply, right? So that's also one thing, which is kind of aiding better profitability because now the customers are used to paying for delivery charges. They are kind of used to ordering that particular product with lesser discounts, right? And also second thing you have to check is the competitive intensity. So I think clearly the larger ones are becoming larger in the ecosystem. So if you look at food tech, where we started off with, you have like almost 6 to 7 players in India in food tech, and today we're just down to 2. So I think this scenario will emerge for other segments as well, whether you call it beauty, personal care, whether you call it, some player will have a niche in terms of fashion, some around commerce. And, it's all about the ecosystem, right? I mean, most of these players, if they can actually milk a very big chunk of their revenues or profitability from advertising, right? Because advertising is the next big thing. Digital advertising is seeing huge uptake in commerce, not only in India, but globally as well. So I think they're going to see the benefit of that once they have a sticky customer base, once they have a large customer base, and advertising income will just flow to the EBITDA, and that will enhance profitability further.
Companies are likely to do better and faster growth than others in this kind of scenario, because then you have to pick and choose and do it rather wisely. Because just looking at a Paytm in particular, Karan, I see that their lending business has grown well. Their loan disbursals are on the rise. So I just want to get to understand from you what you think is going to drive growth for some of these companies higher than others that will turn in value for investors.
So I think investors are also going to be selective in terms of giving valuation multiple to these companies. I think the investors are okay in terms of compromising growth unless the growth is not too low. So for example, I think investors are generally okay with growth rates of 20-25% for these new age companies, unless there is a path to profitability or the companies are already profitable and looking at expanding margins, right? So, and the companies which are executing well, probably doing 20% growth plus consistently, doing a profitability number, their valuation multiples will be at a hefty premium. So it's going to be pick and choose now with the new age pack as well. It's not going to be that 3 years ago you saw every new age company getting a very hefty premium valuation multiple because they came at that time when they were chasing high growth rates. Now I think it's going to be a selective approach. Companies which are kind of showcasing that path to profitability with growth rates which are sustainable, they will be given a hefty premium versus other peers.
And among investors, do you think there's a certain class that should be investing in these new age stocks? Do you need a good risk appetite to park money in these counters? And how long-term an outlook do you need on them, even at this point, while we are seeing them make these positive moves?
Yeah, I think clearly there is a change in sentiment within the investor community as well. I think they are more confident because it's not just a one quarter phenomenon. I think Zomato, if you look at the numbers of 2.5% EBITDA as a percentage of GOV, it's taken them 4 quarters to get there. And they've been, surprising the street and the analysts every single quarter. So it's also about these companies doing so well, wherein they have kind of, done much better than their guidance. The part to profitability has actually got preponed rather than postponed. So I think that is also leading to a big positive surprise, and that's why we're seeing the spike in prices.
Thanks very much for joining us and giving us your perspective on these new age counters.